Hey guys, this is your host Nitin Binhani and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's episode, we would delve into the sudden shutdown of Kenko Health, an Indian health tech startup that had raised $13.7 million and yet found itself out of cash, as reported by Economic Times and Business Standard. It's a stark reminder that even with substantial investor backing, the road to startup success is often fraught with challenges.
First, the disclaimer. The content of this podcast is based on media reports and is for informational purposes only. We do not verify the accuracy of the information presented, nor make any claims about the startups or individuals mentioned in this podcast.
Let's dive into the journey of Kenko Health in two stages: rise and subsequent downfall, along with a summary on the lessons that we can learn from it. 1. The rise of Kenko Health. Founded in 2019 by Aniruddha Sen and Dhiraj Goel, Kenko Health specialized in offering subscription-based health plans that covered outpatient department, OPD benefits, medicines, healthcare products, etc., making it a one-stop shop for healthcare needs. With significant backing from investors like Peak XV Partners, formerly Sequoia Capital, Benext, or Rios Venture Partners, Kenko Health managed to raise $13.7 million in the last 3 years. Kenko was seen as a promising player in the insurtech space and touted as a disruptor in the traditional insurance sector, where it leveraged technology to reach the underserved. The startup showed significant revenue growth, jumping from $597,000 in FY 2022 to $10.47 million in FY 2023, an impressive 17x growth in just 1 year. However, the growth, managing cash flow, and maintaining investor confidence were the key and ongoing challenges for Kenko Health, as it stumbled on all these fronts. 2. The downfall. Despite the initial growth, hype, and strong investor support, Kenko Health's downfall seemed imminent due to challenges in growth and cash flow management. Kenko hasn't even paid salaries to its 100 employees for the past few months. Its offices in Mumbai and Bengaluru were shut down. It laid off 20% of its workforce, roughly 60 employees, in 2023. Unfortunately, the company has run out of funds or cash, and we were unable to infuse equity capital in time due to various internal reasons, wrote the co-founder Aniruddha Sen to his employees in an email, formally informing them about Kenko's shutdown. Kenko's downfall was also attributed to its inability to secure a crucial insurance license from the Insurance Regulatory and Development Authority of India, IRDAI. The situation further deteriorated when the startup faced legal action from its creditors. Kenko was taken to the National Company Law Tribunal, NCLT, by a debt fund that had extended a loan to them, as if the final nail in the coffin. 3. Lessons for entrepreneurs. A. Sustainable growth over aggressive scaling. It's tempting to scale rapidly when you've got investor money in the bank, but it's critical to ensure that this growth is sustainable. Kenko Health's cash burn rate too appeared to be unsustainable. We've often seen investors pushing founders for growth at all costs, which often devastates 90% of the startup. So, monitor your burn rate closely. It's critical to balance growth with financial prudence. And do not scale up until you've achieved product-market fit. B. Revenue model and product-market fit. Kenko's subscription model, though innovative, didn't really resonate with the market dynamics. Profitable revenue streams seemed more challenging than expected. So validate your revenue model thoroughly. Ensure that your product or service drives customer acquisition, retention, and profitability. C. Operational challenges. Scaling operations without a strong foundation can lead to inefficiencies that eat into your cash reserves. Kenko faced challenges in scaling its operations efficiently, particularly in areas like customer acquisition, service delivery, and managing TPA partnership. Focus on building robust processes and systems before pushing for aggressive expansion. D. Investor relations. Kenko Health's investors were forced to drag the startup to the National Company Law Tribunal, NCLT, a move that suggests severe breakdowns in communication and trust between the founders and its investors. When investors lose confidence, it's often the beginning of the end for a startup. Finally, I hope this episode reminds the entrepreneurs to build strong, resilient businesses. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.
And with this, we have reached at the end of this podcast. Thanks for your valuable time and please like, comment and share.